Question 1. The primary purpose of the Investment Company Act of 1940 is to regulate which of the following? A. Broker-dealer advertising and sales literature. B. The issuance of new corporate debt securities. C. The structure and operation of investment companies. D. Insider trading and market manipulation. Answer: C. The structure and operation of investment companies. The Investment Company Act of 1940 is the foundational piece of legislation designed to regulate companies whose primary business is investing, reinvesting, and trading in securities, which are generally categorized as investment companies like mutual funds. This act imposes specific requirements on the organizational structure and operating procedures of these entities to protect the public investors who buy their shares. Key provisions cover things like portfolio management, capital structure, and sales practices, ensuring that investment companies are properly managed and transparently operated. Understanding that the 40 Act governs mutual funds and other collective investment vehicles is essential because these products are the core focus of a Series 6 license. Here's an easy way to remember. The 40 Act deals with the operation of the company itself, while the 33 Act deals with the sale of the security. Question 2. A registered representative, RR, has decided to resign from their broker-dealer. Which form must the broker-dealer file with FINRA to notify them of the termination? Form U4. B. Form U5. C. Form BD. D. Form N3. Answer B. Form U5. When a registered representative resigns or is terminated, the employing broker-dealer is required to file a Form U5, Uniform Termination Notice for Securities Industry Registration, with FINRA within 30 days. This form provides essential details regarding the termination, including the reason for separation, which is crucial for industry oversight and tracking a representative's history. The representative remains subject to FINRA's jurisdiction for 2 years following the effective date of the termination as stated on the U5, meaning they can still be investigated for actions that occurred while they were registered. Remember, a representative starts with a U4 and stops with a U5. Question 3. Under FINRA rules, when must a customer's account be approved for options transactions by a registered options principal, ROP? A. After the first options order is executed. B. Prior to the first options order being executed. C. Within 15 days of the first options transaction. D. Before the options disclosure document, ODD, is sent. Answer: B. Prior to the first options order being executed. Before a customer can place a single trade in an options account, the account must be formally approved by a registered options principal, ROP, which ensures the firm has properly vetted the customer's eligibility and suitability for the specific risk of options trading. This requirement is a critical investor protection measure because options are generally considered more complex and higher risk products than mutual funds. While the options disclosure document, ODD, must be provided to the customer before the approval, the final step to authorize trading is the ROP sign-off. The key clue here is prior to the first order execution, as approval cannot happen retroactively. Question 4. All of the following are types of investment companies under the Investment Company Act of 1940 except A. Face amount certificate companies. B. Unit investment trusts, UITs. C. Exchange-traded funds, ETFs. D. Management companies. Answer: C. Exchange-traded funds, ETFs. The Investment Company Act of 1940 specifically defines 3 types of investment companies: face amount certificate companies, unit investment trusts, UITs, and management companies, which include open-end mutual funds and closed-end funds. While exchange-traded funds, ETFs, are similar to investment companies and often hold a portfolio of securities, they are generally structured as open-end funds or UITs but trade on an exchange, making them distinct from the 3 statutory classifications. The Series 6 focuses heavily on the 3 core types, so recognize that ETFs, despite their popularity, are typically treated as a separate, exchange-traded structure within the broader category. An easy way to distinguish them is to remember the 3 statutory categories are the only ones specifically named in the Act. Question 5. The maximum sales charge that an investor can pay on a mutual fund purchase, as regulated by FINRA, is A. 9.5% of the offering price. B. 8.5% of the offering price. C. 7.25% of the net asset value, NAV. D. 5% of the public offering price. Answer B. 8.5% of the offering price. FINRA rules permit a maximum front-end sales charge of 8.5% of the public offering price (POP) for mutual funds that do not offer specific services like automatic reinvestment of dividends at NAV or cumulative quantity discounts, breakpoints. If a fund fails to offer these services, the maximum allowable sales charge is reduced to 7.25% or even lower, emphasizing that sales practices must be reasonable and in the public interest. The maximum sales charge is a key investor protection rule designed to prevent brokers from recommending funds with excessively high loads. Always associate the 8.5% maximum with funds that meet the breakpoint and dividend reinvestment criteria. Question 6. The net asset value, NAV, per share of a mutual fund is calculated. A. Weekly based on the closing price of the last security sold. B. Daily usually at the close of the major stock exchanges. C. Monthly based on the average price of the securities in the portfolio. D. Only upon the liquidation of the fund. Answer B. Daily usually at the close of the major stock exchanges. A mutual fund's net asset value, NAV, per share, which is the price at which investors buy shares of a no-load fund or redeem shares of any fund, must be calculated at least once daily. This calculation is typically performed at the close of the New York Stock Exchange, NYSE, which is 4 p.m. Eastern Time, reflecting the current market value of all the securities held in the fund's portfolio minus its liabilities. The calculation is essential for ensuring that investors who place orders receive a fair and current price, as mutual fund shares are purchased and redeemed at the next computed NAV. An order received after 4 p.m. will receive the NAV calculated on the following business day. Question 7. A customer is considering purchasing a variable annuity. Which of the following is not a factor used to determine suitability for this investment? A. The customer's tax status. B. The customer's investment time horizon. C. The customer's need for life insurance protection. D. The customer's liquidity needs. Answer: C. The customer's need for life insurance protection. Suitability for a variable annuity focuses on the investor's ability to benefit from the tax-deferred growth and the contract's annuitization phase, making factors like tax status, investment time horizon, and liquidity needs highly relevant. A variable annuity is primarily an investment vehicle for retirement savings and does not serve as a replacement for traditional life insurance, which is designed to provide income or capital to beneficiaries upon the insured's death. When assessing suitability, the registered representative should focus on whether the customer needs the tax-deferred growth and the guaranteed income stream that the annuity phase provides. Variable annuities are savings and retirement tools, not pure life insurance products. Question 8. The term breakpoints in the mutual fund industry refers to A. The minimum account balance required to avoid an annual maintenance fee. B. Sales charge reductions offered for large dollar mutual fund purchases. C. The date at which the fund's expense ratio is calculated. D. The required holding period to avoid a deferred sales charge. Answer B. Sales charge reductions offered for large dollar mutual fund purchases. Breakpoints are thresholds for mutual fund purchases where the upfront sales charge, or load, is reduced as the dollar amount of the investment increases, offering a price reduction incentive to larger investors. This is a crucial investor protection concept because a broker who fails to inform a customer of an available breakpoint is committing a violation known as a breakpoint sale. To qualify for a breakpoint, an investor may use a lump sum purchase, a letter of intent, LOI, to commit to future purchases, or rights of accumulation, ROA, which allows combining current purchases with prior holdings. Always remember that breakpoints equal sales charge discounts for volume. Question 9. An individual can contribute to a Roth IRA if they meet which of the following requirements? A. They are at least 59.5 years old. B. They have earned income above a certain limit. C. They have earned income and their modified adjusted gross income, MAGI, is below a certain limit. D. They have a non-working spouse. Answer: C. They have earned income and their modified adjusted gross income, MAGI, is below a certain limit. The ability to contribute to a Roth IRA is dependent on two key factors. The individual must have earned income from a job or self-employment, and their income must fall below specified modified adjusted gross income, MAGI, limits set by the IRS, which phase out eligibility for high earners. Roth IRAs are popular because contributions are made with after-tax dollars, allowing all qualified distributions in retirement to be entirely tax-free. The income limit is the main distinction from a traditional IRA, which only requires earned income. Question 10. A statutory disqualification from association with a FINRA member firm would result from a conviction of a felony within the last A. 5 years, B. 7 years, C. 10 years, D. 15 years. Answer, C. 10 years. A person is subject to statutory disqualification, SD, if they have been convicted of any felony or a misdemeanor involving securities, investments, fraud, extortion, or other financial misconduct within the last 10 years, which prevents them from associating with a FINRA member firm unless specific permission is granted. SD is a crucial regulatory tool designed to protect the investing public by barring individuals with serious criminal or disciplinary backgrounds from the securities industry. This 10-year period is a hard and fast rule, and it is a key element of the background check process when completing Form U-4. Question 11. Which document must be provided to a customer at or prior to the time an options account is approved? The simplified prospectus. B. The options disclosure document, ODD. C. The options confirmation statement. D. The customer account agreement. Answer, B. The options disclosure document, ODD. The options disclosure document, ODD, which provides detailed, standardized information on the risks and characteristics of options, must be provided to a customer at or before the time their account is approved for options trading. This is a fundamental regulatory requirement intended to ensure that investors are fully aware of the product's risks before they are authorized to place a trade. While the customer account agreement is also required to be signed, the ODD is the specific risk disclosure mandated by the Options Clearing Corporation, OCC, rules. Question 12. Which type of investment company issues shares that are traded on an exchange or over the counter and often trade at a discount or premium to their net asset value, NAV? A. Open-end management company, mutual fund. B. Closed-end management company. C. Unit investment trust, UIT. D. Face amount certificate company. Answer, B. Closed-end management company. Closed-end management companies issue a fixed number of shares only once during their initial public offering, IPO, and afterward, these shares trade publicly on an exchange or the OTC market just like shares of common stock. Because these shares are traded based on supply and demand in the open market, their market price can fluctuate and often trades either above at a premium or below at a discount their underlying net asset value, NAV, per share. This is the main characteristic that differentiates them from open-end funds, or mutual funds, which continuously issue and redeem shares at their current NAV. Question 13. A mutual fund that has a net asset value, NAV, of $10 and a public offering price, POP, of $10 is known as what type of fund? A. A closed-end fund. B. A load fund. C. A no-load fund. D. A variable life fund. Answer, C. A no-load fund. In the mutual fund industry, a no-load fund is defined as one where the public offering price, POP, is the same as the net asset value, NAV, because it does not charge a sales commission or front-end load to purchase the shares. Since the calculation of the POP is NAV plus the sales charge, if the POP equals the NAV, the sales charge component must be 0. This structure means that all of the investor's money immediately goes into purchasing the fund shares, though no-load funds still charge ongoing operating expenses like 12b1 fees. Therefore, the key financial clue in the question is the equality of the NAV and POP. Question 14. What is the maximum age at which a traditional IRA owner is required to begin taking required minimum distributions, RMDs? A. Age 59 and a half. B. Age 65. C. Age 70 and a half. D. Age 73. Answer, D. Age 73. The age at which a traditional IRA owner must begin taking required minimum distributions, RMDs, was most recently updated by the Secure 2.0 Act to age 73, though the age was 70 and a half and then 72 in prior years, making it a critical current rule to know. RMDs are mandatory annual withdrawals that must be taken to prevent permanent tax deferral on the retirement savings, and failure to take the proper amount results in a significant tax penalty. The key concept is that the government allows tax deferral up to a certain point, after which it forces the distribution and subsequent tax payment. Question 15. The purpose of a mutual fund's expense ratio is to disclose A. The maximum sales charge charged to the customer. B. The percentage of the fund's assets used to cover operating expenses. C. The return of the fund compared to its benchmark. D. The amount paid to the fund's custodian bank. Answer B. The percentage of the fund's assets used to cover operating expenses. The expense ratio is a crucial metric for comparing mutual funds, representing the percentage of a fund's total assets that are used to pay for all of the fund's annual operating expenses, including management fees, administrative costs, and 12b-1 fees. This ratio is deducted directly from the fund's assets and therefore directly reduces the investor's return, making a lower expense ratio generally more favorable. Because the expense ratio is a mandatory disclosure, it is prominently displayed in the prospectus to provide transparency on the true cost of owning the fund. Question 16. Which of the following best describes the tax treatment of contributions to a Roth 401k? A. Contributions are tax deductible in the year they are made. B. Contributions are made with after-tax dollars. C. Contributions are subject to tax only upon distribution in retirement. D. Contributions are always matched by the employer on a pre-tax basis. Answer B. Contributions are made with after-tax dollars. Contributions to a Roth 401k are made with after-tax dollars, meaning the employee pays income tax on the money before it is invested in the plan. This is the central feature of a Roth account, as it allows all qualified withdrawals in retirement, including the earnings, to be completely tax-free. This characteristic contrasts directly with the traditional 401k, where contributions are pre-tax, tax-deductible, and distributions are taxed as ordinary income. The trade-off is paying tax now for tax-free growth later. Question 17. The primary reason a variable life insurance policy is considered a security is because A. The premium payments are flexible. B. The cash value is invested in a separate account whose performance is not guaranteed. C. The death benefit is guaranteed not to fall below a minimum level. D. The policy is regulated by the state insurance commissioner. Answer B. The cash value is invested in a separate account whose performance is not guaranteed. Variable life insurance is classified as a security and requires a Series 6 license to sell because the policy's cash value is invested in the broker-dealer's separate account, which consists of various sub-accounts whose investment performance is not guaranteed. Since the investor bears the investment risk, the product must be registered as a security under the Securities Act of 1933 and the Investment Company Act of 1940. This is the crucial distinction from whole life insurance, where the insurer guarantees the cash value and therefore is considered solely an insurance product. The separate account and investor risk are the key security identifiers. Question 18. Under anti-money laundering (AML) regulations, a member firm is required to file a suspicious activity report (SAR) within how many days of becoming aware of a suspicious transaction? A. 5 calendar days. B. 10 calendar days. C. 30 calendar days. D. 45 calendar days. Answer C. 30 calendar days. If a broker-dealer becomes aware of a transaction or series of transactions that it knows, suspects, or has reason to suspect involves funds derived from illegal activity or is designed to evade regulations, it must file a suspicious activity report, SAR, with FINRA within 30 calendar days of the detection. The purpose of the SAR is a critical component of the Bank Secrecy Act and is a key tool in combating financial crimes, ensuring that suspicious activities are reported to the proper government authority for investigation. Remember that the 30-day requirement applies to the SAR filing, which must also remain strictly confidential. Question 19. A registered representative, RR, wants to share in the profits and losses of a customer's account. Which of the following is required? A. Sharing is prohibited under all circumstances. B. Sharing is permitted only if the customer signs a disclaimer. C. Sharing is permitted only with the firm's written permission and the sharing is proportionate to the RR's capital contribution. D. Sharing is permitted only if the RR is a member of the customer's immediate family. Answer C. Sharing is permitted only with the firm's written permission and the sharing is proportionate to the RR's capital contribution. FINRA rules strictly govern account sharing to prevent potential conflicts of interest and exploitation, allowing a registered representative to share in the profits and losses of a customer's account only if the member firm provides prior written authorization and the sharing is directly proportionate to the financial contribution the RR made to the account. An exception to the proportionality rule exists only if the customer and the RR are immediate family members, but even then the firm's written permission is still required. The proportionality rule is the core concept being tested, ensuring that the representative takes the same financial risk as the client. Question 20. When opening a new cash account for a non-institutional customer, which piece of information is required under the Customer Identification Program, CIP? A. The customer's educational background. B. The customer's account number at another brokerage. C. The customer's physical address. D. The customer's net worth. Answer: C. The customer's physical address. The Customer Identification Program, CIP, mandated under the USA Patriot Act, requires member firms to verify the identity of every new customer, and this process specifically requires collecting the customer's name, date of birth, legal address, and a taxpayer identification number, e.g., Social Security number. The customer's physical street address is required because a post office box is not sufficient for identity verification. CIP is a fundamental component of anti-money laundering (AML) compliance, serving as a critical first step to prevent financial crime. Question 21. A mutual fund that primarily invests in short-term money market instruments and seeks to maintain a stable net asset value, NAV, of $1 per share is known as A. Balanced fund. B. Growth fund. C. Money market fund. D. Index fund. Answer: C. Money market fund. A money market fund is an open-end mutual fund that invests exclusively in high-quality short-term debt instruments, such as treasury bills and commercial paper, with the primary objective of preserving capital and maintaining a stable net asset value, NAV, of $1 per share. Although not guaranteed, this stable NAV makes it an extremely liquid and low-risk investment, often used as a temporary parking place for cash reserves. This fund type is critical for the Series 6 because it is the safest of the mutual fund categories. Question 22. What is the standard settlement period for the purchase or sale of open-end, mutual fund, shares? A. T+1, trade date plus 1 business day. B. T+2, trade date plus 2 business days. C. T+3, trade date plus 3 business days. D. Same day trade date. Answer: B. T+2, trade date plus 2 business days. The standard settlement period for the purchase or sale of open-end investment company shares, also known as mutual fund shares, is trade date plus 2 business days, plus 2 T+2. Settlement refers to the date when the actual exchange of securities and funds is finalized, and this T+2 requirement aligns mutual funds with the settlement period used for most corporate stocks and bonds. Understanding settlement is important for customers as it dictates when the buyer must deliver funds and the seller will receive proceeds. Question 23. A registered representative, RR, must disclose to their broker-dealer any private securities transaction they intend to engage in. This disclosure requirement is commonly referred to as A. Churning. B. Selling away. C. Commingling. D. Reverse churning. Answer: B. Selling away. Selling away or participating in a private securities transaction occurs when a registered representative executes a securities transaction outside the normal course or scope of their employment with their member firm. If the RR will receive compensation, the firm must provide prior written approval. If no compensation is received, the firm must simply be notified in writing. This rule exists to ensure that the broker-dealer maintains proper supervision over all securities-related activities of its RRs, which is a key investor protection measure. Question 24. A customer invests $25,000 into a mutual fund and signs a letter of intent, LOI, to invest an additional $25,000 over the next 13 months to reach the $50,000 breakpoint. If the customer fails to complete the LOI, the firm can A. Cancel all future purchases for the customer. B. Suspend the customer's account for non-compliance. C. Retroactively charge the higher sales load on the purchased shares. D. Forfeit the customer's initial investment. Answer: C. Retroactively charge the higher sales load on the purchased shares. A letter of intent, LOI, allows an investor to qualify for a reduced sales charge, a breakpoint, based on a future commitment to invest a specified sum, and to protect the firm, shares equivalent to the difference in the sales load are typically held in escrow. If the customer fails to meet the commitment within the agreed-upon 13 months, the fund company can liquidate the escrowed shares to retroactively collect the higher sales load that would have applied to the initial purchase without the LOI. The LOI is a voluntary commitment, and the penalty is simply a recalculation of the sales charge. Question 25. Which characteristic distinguishes a variable annuity during the accumulation phase? A. The customer receives guaranteed periodic income payments. B. The contributions are tax deductible. C. The value of the separate account fluctuates with the performance of the underlying investments. D. The death benefit is typically fixed and not tied to the separate account performance. Answer: C. The value of the separate account fluctuates with the performance of the underlying investments. The accumulation phase of a variable annuity is the period during which the investor contributes money to the contract, and the value grows on a tax-deferred basis, with its growth directly tied to the performance of the underlying investments, sub-accounts, held in the separate account. Since the value is not guaranteed and can rise or fall with the market, this period is characterized by investment risk borne by the contract owner. This contrasts with the annuitization phase, where the separate account value is converted into a stream of periodic income payments. Question 26. Which of the following communications must be filed with FINRA 10 business days prior to first use? A. Correspondence sent to a single retail customer. B. A retail communication that includes a ranking or comparison created by the member firm. C. An institutional communication. D. A prospectus prepared in accordance with SEC rules. Answer: B. A retail communication that includes a ranking or comparison created by the member firm. Retail communications, which are materials distributed to more than 25 retail investors within a 30 calendar day period, must generally be filed with FINRA, and those that specifically include a self-created ranking or comparison must be filed 10 business days prior to first use. This pre-filing requirement is imposed due to the potentially misleading nature of internally generated performance claims or comparisons, making it a key investor protection rule regarding advertising standards. Most other retail communications are filed within 10 business days after first use, so the prior to first use clue is critical. Question 27. The document that grants a non-owner the authority to make investment decisions and execute trades in a customer's account is known as A. Hypothecation Agreement. B. Customer Identification Program (CIP) form. C. Power of Attorney (POA). D. Beneficiary Designation Form. Answer: C. Power of Attorney (POA). A power of attorney (POA) is the legal document that grants a third party, often referred to as an agent or attorney-in-fact, the authority to act on behalf of the account owner, which typically includes the ability to place orders and make investment decisions. The firm must receive a copy of the POA and confirm the authority before the third party is allowed to trade in the account. When a POA is non-durable, it is automatically revoked upon the account owner's incapacitation or death. Question 28. Which of the following parties is primarily responsible for determining the suitability of a mutual fund recommendation for a particular client? A. The mutual fund's portfolio manager. B. The registered representative, RR, making the recommendation. C. The clearing corporation handling the trade. D. The Financial Industry Regulatory Authority, FINRA. Answer: B. The registered representative, RR, making the recommendation. Under FINRA Rule 2111, the registered representative is primarily responsible for performing the necessary due diligence and obtaining sufficient customer information to ensure that any securities recommendation made, including a mutual fund, is suitable based on the customer's investment profile. This obligation, known as the suitability rule, requires an RR to have a reasonable basis to believe the recommendation is in the customer's best interest. Suitability is a core ethical and regulatory concept, making the RR the frontline defense for investor protection. Question 29. A 529 college savings plan is classified as which type of security? A. Corporate bond. B. General obligation bond. C. Municipal fund security. D. Treasury security. Answer, C. Municipal fund security. A 529 college savings plan is legally defined as a municipal fund security, which is a type of state-sponsored savings plan that invests in an underlying portfolio of securities, typically mutual funds. These plans are specifically exempt from registration with the SEC under the Securities Act of 1933 but are regulated by the Municipal Securities Rulemaking Board, MSRB, for sales practices. The key takeaway for a Series 6 exam is recognizing that 529 plans, while functioning much like mutual funds, are government-sponsored, state-level savings plans. Question 30. All of the following are considered statutory investment companies that a Series 6 representative may sell except A. Open-end funds. B. Closed-end funds. C. Unit investment trusts, UITs. D. Individual stocks. Answer, D. Individual stocks. The Series 6 license authorizes a representative to sell shares of statutory investment companies, which include open-end management companies, mutual funds, closed-end management companies, and unit investment trusts, UITs, as well as variable contracts. The license does not permit the sale of individual corporate stocks, corporate bonds, municipal bonds, or options, which generally requires the more comprehensive Series 7 license. The scope of the Series 6 is limited to collective investment schemes and variable insurance products. Question 31. The primary tax advantage of a traditional IRA is that contributions are often A. Exempt from state income tax. B. Tax deductible in the year they are made. C. Eligible for a tax-free distribution in retirement. D. Matched by the employer. Answer B. Tax deductible in the year they are made. The primary tax advantage of a traditional IRA is that contributions are often tax deductible in the year they are made, meaning the contribution reduces the individual's taxable income for that year, leading to tax savings now. The funds then grow tax-deferred until retirement, when all distributions are taxed as ordinary income. The trade-off is receiving the tax break immediately in exchange for paying tax later, which is the exact opposite of the Roth IRA structure. Question 32. In a variable life insurance policy, the separate account is where A. The insurer's general assets are held to guarantee the death benefit. B. The fixed minimum cash value is maintained. C. The premiums less expenses are invested in sub-accounts chosen by the policy owner. D. The policy's loans are collateralized. Answer, C. The premiums less expenses are invested in sub-accounts chosen by the policy owner. The separate account of a variable life insurance policy is a segregated pool of assets, distinct from the insurer's general account, where the policy owner's net premium dollars, premiums minus expenses, are invested in sub-accounts, like mutual funds, that the owner chooses. Because the separate account's performance dictates the cash value and potentially the death benefit, it carries investment risk and is why the product is regulated as a security. The key to variable products is the separation of policy assets and the client's choice of underlying investments. Question 33. A broker-dealer must make a final determination of whether to accept or decline a customer's account transfer request under the Automated Customer Account Transfer Service, ACATS, within A. 1 business day. B. 3 business days. C. 5 business days. D. 7 business days. Answer, A. 1 business day. When a customer wants to transfer their account from one broker-dealer, the carrying firm, to another, the receiving firm must submit the transfer instruction via ACATS, and the carrying firm must make a determination to validate or reject the transfer within 1 business day of receipt. This rule is designed to ensure a quick and efficient account transfer process, protecting customers from unnecessary delays or obstruction by the carrying firm. This one-day validation rule is a critical regulatory standard that streamlines customer account mobility. Question 34. What is the standard free look provision period for a variable life insurance policy? 7 days. B. 10 days. C. 20 days. D. 45 days. Answer, D. 45 days. While most insurance products have a standard 10-day free look period, variable life insurance policies must have a minimum free look period of 45 days from the date the policy is executed or 10 days from the date the owner receives the policy, whichever is later. This extended period is required due to the dual nature of variable life as both an insurance and a securities product, ensuring the client has ample time to review the complex terms and inherent investment risks before committing. This extended 45-day window is a common test question used to distinguish variable life from other insurance policies. Question 35. For a new issue of an open-end investment company mutual fund, the prospectus must be delivered to a purchaser. A. Within 10 calendar days after the purchase. B. Only if requested by the purchaser. C. At or before the confirmation of the sale. D. Within 30 calendar days after the sale. Answer: C. At or before the confirmation of the sale. Under the Securities Act of 1933, which mandates disclosure for new securities issues, the full statutory prospectus for a mutual fund must be delivered to the investor at or before the confirmation of the sale, although a summary prospectus is typically sent first. This rule ensures that the customer receives the complete, material information about the investment company, including its objectives, risks, and fees, before the transaction is finalized. Prompt delivery of the prospectus is a cornerstone of investor protection and transparency.